Chapter 8, Part 2. Now we're going to look at inventory valuations using the periodic method. Now, there are certain cost flow assumptions that can be used when you're trying to price inventory. Specific identification is only used when you have very unique items. Each one is different. An example might be a high-end jewelry store, a yacht store, wherever they sell everything that the price is unique to the specific item that's being sold. But most large corporations are going to use FIFO, which is the first cost in is the first cost out when determining how much an item should cost when it's sold. We have LIFO, which says that the last cost in is the first cost out to cost of goods sold. And then we have the weighted average or average cost, which means we're going to determine a per unit cost by taking cost divided by units, and that's going to give us an average price when there is a sale. So now let's look at an example. Okay, in our example, we have a beginning inventory. We have a purchase on the 4th. We have a sale on the 20th. We bought more goods on the 22nd, and we had another sale on the 26th. Now, here's what I like to do is before I do anything, I reformat this, specifically in this case because it is for the periodic system. First, what I do is figure out my total cost of goods available for sale, because this is what I'm going to be allocating between ending inventory and cost of goods sold. So in this case, I had total goods available for sale of 6,000, and they had a total cost of 117,000. So that's the amount that I should have as a total when I come up with my number for cost of goods sold and ending inventory. When I add them together, they have to equal 117. Next, what was my sale if I'm trying to figure out gross profit? And in this case, when I add up the 2 points of when things were sold, I sold 4,700 units, and the sale price of those is $147,600. Now I have enough information to figure out how many units are ending inventory. So what I'm trying to do when I do these methods is I'm trying to allocate the 117 between the units sold and the units in ending inventory. And like I say, we're going to go over 3 methods. You're going to get 3 different answers. Now, the easy part about doing periodic is that it doesn't matter when the items were sold because we're not going to do anything till month end. So you have to take that into consideration when you're going through and doing your adjustments. The first thing you always want to check is this perpetual or periodic. If it's periodic, we don't care when we sold it. And if if it's perpetual, we do care. So let's start with FIFO. So we had, again, since we don't care when it's bought, we don't have to set it up to show the purchases. We know that we had $117,000 for our cost of goods available for sale, and 4,700 units were sold. So now we're going to go through the process of first in is the first out. So what that means when we do the cost, the first thing we're going to do is we're going to take out 1,000 units at $12. Now we're going to keep doing this till we come up with 4,700 units. Remember, you cannot take 4,700 units at $12 because you only had 1,000 units. So remember that. So now we have 0 of those left. Now we're going to take 2,000. We still have 1,700 left, and we're going to now take 2,000 at $18. And now we're going to take 1,700 from here, leaving 1,300, and we're going to add that up, and that gives us our cost of goods sold. We sold $4,700, 4,700 units, and using FIFO, we end up with cost of goods sold of $87,100. Now, if prices are rising, when you use FIFO, you're going to get the lowest cost of goods sold because what's going to be left in ending inventory is your most recent purchases. So, ending inventory is going to be $1,300 times $23. Again, when we add those two up, we get our 117, which is what we need to do. And now we can do our gross profit, which is our sales minus our cost of goods sold, which in this case give us profits of $60,500. Now, if we were to take this same problem and do it like your homework, it would look like this. This is the form they use. They have one column for cost of goods available for sale, which is the same as what we had in our schedule. Then they show the cost of goods sold under periodic. Again, we assume that for the 4,700 units, we take the oldest units first and work our way down. And then that last column tells us what's left in ending inventory. Again, you get the same answer. Now let's do the same problem using LIFO, which is the last cost in is the first cost out for cost of goods sold. So when we sold our 47 units, we're first going to take 3,000 out of here, leaving none. So we're going to have 3,000 at $23. Then we still have 1,700 units to account for, and we're going to take it out at 18, leaving 300. And now we can do our cost of goods sold, which is going to be higher because we're using our most recent prices, and prices have gone up. And our ending inventory is going to be 1,000 at 12 and 300 at 18, which gives us 17,400. We're going to add that up. We have our 117, which we always want to check. And now we can look at our gross profit. As you can see, it's less. And again, that is because we're using our most recent prices, and in this example, prices have risen. Now again, if we were to do this like your homework, it would look like this. And again, we have total cost of goods available for sale in our first column. We have our cost of goods sold, which is based on 4,700 units. And then we have our ending inventory based on 1,300 units. Now the last is the easiest. This is called weighted average for periodic. This is very easy and not so easy for perpetual. What we're going to do is take our total cost of goods available for sale and divide by our total units, which gives us an average cost of $19.50. Ending inventory would be 1,300 units times $19.50. Cost of goods sold would be 4,700 units times $19.50. Add that together, we get our total cost of goods available for sale. And our gross profit always is going to be between the gross profit and cost of goods sold under FIFO and LIFO. If prices are rising, but it'll always be in the middle because it's average. So now here is a comparison. As you notice, under FIFO, we get a higher gross profit because our cost of goods sold is less. However, we get a higher ending inventory. Under LIFO, we get a lower gross profit, but we also get a lower ending inventory. And if you notice, weighted average is between those two numbers. If prices are rising, remember, you're always going to get a better bottom line under FIFO, which is what usually companies like to use for reporting purposes. And for tax purposes, they like to use LIFO. And this concludes my presentation on Part 2, Inventory.